Hey, what's up guys? It's Ezekiel Chiu here, and today we're going to show you how to effectively spot reversals in the market using the head and shoulders pattern, and 3 easy yet powerful strategies to trade this pattern the next time you see it. So first off, let's talk about what the head and shoulder pattern is. The head and shoulders pattern serve as a trend reversal signal, indicating that the buyers are struggling to push the price higher. It consists of what? A left shoulder followed by a higher high forming the head, and then a right shoulder which is of a lower height. The neckline connects the two lows, and a break below this neckline would suggest a reversal of the previous trend, signaling a move lower. So this summarizes the key concept of what the head and shoulders pattern looks like. Now, let's break it down. First off, the left shoulder. The market experiences what? A pullback, but it is uncertain if a reversal will form as what? As pullbacks are common in a trending market. So then, next, the head. The market now trades above the previous high. However, the sellers now take control and then drive the price lower towards the previous swing low, forming the neckline. Next, the right shoulder. The buyers will now attempt again to push the price higher, but then fails to break above the previous high, which is the head. Now the sellers then take control, pushing the price towards the neckline. Now, the neckline. The neckline serves as the final defense line for the buyers. So, a break below the neckline could signal potential move lower, marking the beginning of a downtrend. Biggest mistake that traders often make when trading this pattern is that they think that an uptrend will reverse just because they identify a head and shoulders pattern. Let me show you why. Let's say, for example, you have a trend where the prices are going up higher and higher. Right now, just because you identify a head and shoulders pattern like this one here, the key point is that merely spotting a head and shoulders pattern does not guarantee trend reversal. There are 2 things that you have to take into consideration. Number 1, the strength of the trend. The next one, the duration of the trend. So if the trend has been going on for like, let's say, multiple months, 6, 7 months, and your pattern took only, say, 3 weeks to form, the likelihood of this relatively short pattern reversing this established trend is pretty low. So it is essential, you got to exercise caution and not trade every head and shoulders pattern that you encounter, particularly if they go against a very strong trend. So in such cases, the pattern is more likely to fail. Here's an example. In this case, you see a strong trend as indicated by the length of the time that it has persisted and the number of candles in the 4-hour time frame. The head and shoulders pattern, in contrast, right, is relatively shorter in duration. So when such a head and shoulders pattern appears against a strong and longer term trend, like this example, it is advisable to avoid shorting it. I mean, there's a higher likelihood of you getting stopped out, right? In this instance, the market continued to trade higher. So you got to pay attention to the previous trend before the head and shoulders pattern, right? And this will allow you to kind of filter and identify higher probability setups. Now, once you have identified the head and shoulders pattern and set the neckline around the midpoint of the right shoulder, you can follow these common rules for trading. To manage your risk, place your stop loss where? Just above the peak, the highest point of the right shoulder. In addition, you can determine your potential take profit level, your reward, by aiming for a 1:1 risk to reward ratio relative to the distance between the peak of the head and the neckline in terms of pips. This is in general, it's always like this in theory. So now, when it comes to entering a head and shoulders trade, you would typically wait for price to break the neckline. So this breaking point confirms the pattern formation on the chart. However, there are other ways to enter. So using what? Additional indicators. A more aggressive entry involves placing an order right after the right shoulder peak forms. The risk here is that, without a confirmed neckline break, the market might be in a short consolidation. So continuing the trend and potentially stopping out the aggressive entry. Alternatively, a more conscious approach is to wait for the market to break the neckline, then retest it before moving lower. So if this happens, an entry point is when the price bounces off the neckline rejection and starts heading lower. However, even though this is like, hey, it's a safer approach, right? There are risks that if the neckline break is strong, the price might not retest it and instead just like, hey, drop rapidly towards your TP level, your take profit level. Therefore, you got to understand your trading style and backtest of that specific pair that you're trading to learn about that, for example, that asset, that vehicle characteristic. What happened the last time when there was a head and shoulders, so the last few times when there was a head and shoulders, before you want to decide your best approach towards it. Now, here we go. The 3 strategies. These 3 strategies can offer a more favorable risk to reward ratio and increase the probability of a successful trade. Number 1, the build up. Most of you would identify a head and shoulders pattern and enter a short position upon the breakout of the neckline. They usually place their stop loss above where? The head. This approach often results what? In a large stop loss relative to your potential gains, which means what? Your risk to reward ratio is not going to be good. Here's what I mean. Rather than placing a large stop loss above the head after the breakout, a more effective approach is to wait for the market to form a tight consolidation near the neckline or the support level. So if a breakdown occurs, right, the stop loss can then be set where? Just above the highs of this consolidation, giving you a way better risk to reward ratio. So this first technique, the strategy, is what I call the build up. So instead of immediately shorting on the break of the neckline in the head and shoulders pattern, wait for the build up, a tight consolidation for it to form. When you do this, you can now place your stop loss just above the swing high within the consolidation, giving you like a fantastic RR, right? So now, there are a few variations to it. The build up could look something like this, where the right shoulder is simply a build up and you can just reference it to set your stop loss. And one thing about build up is that when the market moves from a period of low volatility to a high volatility. So in the build up phase, the market experiences low volatility. And this period of reduced volatility often comes before a breakout with increased volatility. So if the market breaks down from this build up, the expansion of volatility can lead to a great risk to reward ratio, because when price consolidates, after a while it gathers that momentum that when it breaks, boom, it usually is going to be a big break, a big move downwards. When you wait for this pattern to form, you not only have a better risk to reward ratio, when the market moves, your TP is going to be way bigger as well because of this pent-up volatility. When it breaks, it often makes a big move. Here's an example of the build-up technique. After the left shoulder, head, and right shoulder, you can observe the build-up forming just beyond where? The right shoulder. Instead of placing your stop loss above the head, you can now reference it by setting it just above the build-up, which is what we have covered. And that's where you can reduce your size of your stop loss, allowing you to have a fantastic RR. Here comes the next one, number 2, the first pullback. What if the market doesn't form a build-up? So wouldn't I miss the move? This technique, right? The first pullback comes in. If the market breaks down without the build-up, wait for the pullback. When the pullback occurs, that's where you can go short on the break of the swing lows. Place your stop loss above the highs of the pullback. The best pullbacks are shallow with small bodied candles. But if you encounter a steep pullback with large bodied candles, that's where you would want to consider avoiding the trade. So if you're worried about missing out on a market move after head and shoulders patterns breakdown, this is where you can use this method, right? The first pullback. Okay, so here's an example. So in this head and shoulders pattern, the market broke below without giving us a chance to enter the trade. However, with the first pullback, that's where the market retraced slightly. So that's where you got another chance to enter when it break below this retracement low. That's where you're going to place a stop loss as reference from this swing high. This shows how by using this first pullback, we can still get an opportunity to catch this move even without a build-up of the initial breakout. Number 3, the retest. When the pullback after the breakout is deeper than expected, that's where you look for a retest. The previous support now turned into resistance, that level would act as an optimal opportunity for us to short the trade. But do note that we don't just want to short it because it touches that level. You want to short it when it comes in combination with price action, candlestick patterns. So here's an example. After the head and shoulders pattern broke down, it retraced. And then it retested the neckline. So this retest offers traders what? 2 potential entry points. Either trading the breakout of the swing low or entering on the retest. Now, the importance of assessing the overall trend, this is what I want to emphasize, as trading against a strong trend is not recommended because it will not likely yield very favorable results. The retest technique serves as a confirmation signal. Now, with this retest technique, it will increase the likelihood of a successful trade. Now, let's do a quick recap. So first off, the head and shoulders pattern indicates a reversal in the market itself. Number 2, avoid shorting the head and shoulders pattern solely based on what? Its presence. If you see it, oh, head and shoulders is always going to reverse. No. You got to access what? The previous trend. If the previous trend is strong and over an extended period of time, right, you got to access that your current pattern, the head and shoulders pattern, is it going to be strong? And is it going to be relatively like short? So you got to be really cautious in that aspect. Number 3, once you identify the head and shoulders pattern, that's where you're going to set the neckline. And the normal way of entering is to place your stop loss where? Just above the right shoulders, the highest point, right? That's where you can do the default pattern and aim for kind of like a 1:1 distance from the neckline to the head and the neckline downwards. Number 4, the build-up involves what? Tight consolidation. We got the 3 techniques, right? The build-up after a consolidation, that is optimal. It gives you a great RR because of the build-up is going to move big time down. And then after which we covered what? The first pullback. That's where, hey, there's no build-up, but it dropped down and then it retraced, but it's not steep. That's where it's the first pullback. That's where you can continue to trade the movement, not the entire move, but you can still continue the trade because just because you miss on entering does not mean that you could not enter this reversal move again. And the last one is when there's a steep pullback, when there's a steep retest. That's where how you can enter with price action entry. I've created a free 5-part training that shows you exactly how I trade. Check out the link in the description below.